Thank you for joining. I'm Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. High inflation, low bond yields, and expensive stock market valuations are causing investors to question the 60-40 portfolio. That is a portfolio of 60% stocks and 40% bonds that has been used by moderate investors for decades. Just because we have near-term challenges, however, with this portfolio doesn't mean we should throw away nearly a decade of a proven track record. Let's go ahead and get into it and take a look at first at 5-year rolling returns of the 60% stock, 40% bond portfolio. But again, the 60-40 bond portfolio. You can see that through history, this has delivered pretty good returns. And we use a 5-year rolling return because we think investors should have a long-term view when using equities. And the gray bars here represent recessions. We're using a simple portfolio, 60% domestic stocks, 40% high quality bonds to prove this point. But you can see performance has been consistent, and this performance has been consistent not only during recessions, through wars, through periods of high inflation like in the 1970s, through low bond yields, high bond yields, and whether a Republican or Democratic president has been in office. This has been a time-tested portfolio, and we think the portfolio will continue to offer value to investors. The average return has been 8.6%, not far behind the return of 9.5% for an all equity portfolio. But the 60-40 has delivered that return with less volatility than an all equity portfolio. The percentage of periods with a positive return is 95%, so a high success rate. And really, the only exception to that would be the Great Depression and a brief period following the 2008 financial crisis. You can see on the far right that the current period, as of the end of October, the trailing 5-year return is 12.7%. That is above the historical average, but it is below the extremes witnessed in the late 1980s and again in the late 1990s. So while we do think internally that we'll have lower returns going forward, this portfolio could once again surprise investors and prove higher returns. But again, it is proven nearly a century of results for this portfolio. Now, if we move to a 10-year rolling return horizon, you'll note that there are no negative periods. And this reflects the benefits of a long-term view. It also reflects the power of staying invested for the long term in equities. No negative returns, and the average return slightly better at 8.8%. All of this despite continued calls in the media and certain consultants that the 60-40 portfolio is dead or won't work in the future. Need not do more than do a few internet searches and you'll see those prognostications back quite heavily over the past 10 to 15 years. Now, let's take a look at stocks as an inflation hedge. And historically, stocks have been the best hedge against inflation. We've got data going back to the early 70s showing 8 different periods where inflation bounced off a low and then ultimately peaked, and stocks still performed well in all of these environments. The early 1970s were particularly severe. That first line there at 72 to December 74 involved 2 recessions and high inflation. That was the weakest return, obviously. But 6 out of the 8 other examples, returns were positive to a tune of 5.6%, even with that 13% decline. If we take that out, the return improves to 8%. So you can see that stocks, despite those increases in inflation, and we don't expect a near 10% increase in inflation, we think the single-digit increase witnessed from 87 through 2018 is probably more representative of what we'll see. And in the current episode, which started in May 2020, inflation has increased by 5.8 percentage points on an annualized basis. Stocks have still had very strong performance. Even if we go back to early this year, which was when the acceleration really began in terms of inflation, stocks have still had a very strong 2021. So I think it's important to remember for investors, stocks are still your best hedge against inflation, and we would remain fully invested. Now let's take a look at bonds, which receive a lot of scrutiny given the low interest rate environment, the prospects of higher interest rates in the future, Fed rate hikes, and of course, inflation. Well, we can get a pretty good idea of what bonds will do in the future. In this chart here, we're showing the 10-year Treasury yield shifted forward 10 years, and then showing the total return of high quality intermediate bonds as measured by the Bloomberg Barclays Aggregate Bond Index. And that's a 10-year annualized return. So some years will be better, some will be weaker, but you can see how closely it tracks to the 10-year Treasury yield. And if the current yield is any guide, bond investors, high quality bond investors, should expect roughly 2% returns on average over the next 10 years. So yes, the bond environment is going to provide lower returns, but we still think that doesn't eliminate the fact that bonds are the best risk mitigation tool. If the stock market were to have a severe sell-off, if the recession were to occur, high quality bonds would provide the best buffer against those types of declines. There is a lot of chatter about alternative investments being used in place of bonds, and while at the margin some changes could be made, and we advocate for a small allocation to alternative strategies, they do not replace bonds as a risk mitigation tool. So as we look forward to the future, we don't think the 60-40 portfolio is dead. We still think it can continue to add value for investors and continue to believe that stocks and bonds should make up the bulk of investors' portfolios. I'm Anthony Valeri. Thanks very much for listening.